Next question. Opus Technologies Ltd, an Indian IT company, is planning to make an investment through a wholly owned subsidiary in a software project in China with a shelf life of 2 years. The inflation in China is estimated at 8%. Operating cash flows are received. Highlight the portion at the year end. For the project, an initial investment of Chinese Yuan 30 lakhs will be in land. Highlight the portion land. The land will be sold after the completion of the project, that is after 2 years, at an estimated value of 35 lakhs Chinese Yuan. The project also requires an office complex at a cost of 15 lakhs Chinese Yuan, payable at the beginning of the project, that is in the year 0. The complex will be depreciated on straight line method basis over the 2 years to 0 salvage value. So we understand that the 15 lakhs divided by 2, 7,50,000 is depreciation. This complex is expected to fetch 5 lakhs Chinese Yuan at the end of the project. The company is planning to raise the required funds through GDR issue in Mauritius. Each GDR will have 5 common equity shares of the company as underlying security, which are currently trading at the rate of 200 rupees per share. So over here 1 GDR is equal to 5 equity shares. Face value is 10, and the current market price of the equity share over here is 200 rupees in the domestic market. The company has currently paid dividend of 25%, which is expected to grow at 10%. So use your calculator. 10 rupees into 25%, 2 rupee 50 paise, and currently paid, that is indicating B0, is 2 rupee 50 paise. The total issue cost is estimated to be 1% of the issue size, that is flotation cost. The annual sales is expected to be 10,000 number of units at the rate of 500 Chinese Yuan per unit. The price per unit is expected to rise at the rate of inflation, which is provided over here, that is 8%. Variable operating costs are 40% of the sales. Fixed operating cost will be 22 lakhs per year and expected to rise again at the rate of inflation, that is 8% in this example. Tax rate applicable in China for income and capital gain is 25%. As per Government of India policy, no further tax shall be payable in India. So when you will repatriate the cash flows over here, there is no tax. India, China, very good relationship. The current spot exchange rate is 9.50 rupees per Chinese Yuan. Nominal interest rate over here is 12% and over there it is 10%. And the international parity hold, you need not to provide it. That is what always we make an assumption. You are required to identify expected future cash flows in China, that is in foreign currency. Determine NPV of the project in Chinese Yuan. It means that say you are required to adopt the foreign currency approach for calculation of answer. Determine whether Opus Technologies should go for the project or not, assuming that say there is neither any restriction on transfer of the funds from China to India, nor any charges or taxes payable on the transfer of the funds. Calculate revised NPV. If OT, that is Opus Technology, can transfer the funds at the end of the project, that is directly at the end of the second year, and internal cash flows are cannot be reinvested in China. That is what they have provided. I request all of you to go through the question, and I want you to tell me the step number 1 answer, that what is the investment to be made in the project. Please write in the chat box. So write down heading NPV of the project, in foreign currency approach. In that, write down step number 1, investment. What is the amount of investment? Land, an amount of 30 lakhs. Then building, an amount of 15 lakhs. Because very simple information is given to us over here, that you are required to purchase land for 30 lakhs. That is year 0 cash outflow, and 15 lakhs at the beginning of the project for the office complex. So the total investment that say you are required to make is very simple to calculate. It is an amount of 45 lakhs. That is year 0 cash outflow. This is in the year 0. Okay. Step number 2, depreciation. I request all of you to write answer in the chat box. What is the depreciation annually? Friends, depreciation calculation is again very simple. It is cost divided by number of years. What is cost? It is 15 lakhs divided by 2. So that comes to 7,50,000 Chinese Yuan per year. You can see that's over here. It has been given that the complex will be depreciated on straight line method basis over 2 years at 0 salvage value. So we understand that the entire cost is required to be written off, and the cost divided by number of years, that is the way we are required to compute the depreciation. Step number 3, terminal cash flow. I request all of you to make calculation of the terminal cash flow year to end and put your answer in the chat box. So in terminal cash flow, we just have to prepare simple working notes for the capital gain or loss, and then we'll make the calculation of the cash flow. So I request all of you to write down answer along with me. Working note number 1, calculation of the capital gain or loss on sale of land, building. For land and building, we can see that we have been provided with the sale value. I think that for land it has been provided as 35 lakhs. Okay. And for building it has been provided as 5 lakhs. So this is 35 lakhs. This is 5 lakhs. Cost. In case of the land, the purchase price was 30 lakhs. No information is provided for indexation, so we are ignoring indexation. And in case of building, we will write the WDV. WDV is 0. So that is capital gain or loss, that is capital gain. Okay, capital gain, it is an amount of 5 lakhs in the first case and again 5 lakhs in the second case. So that is a simple capital gain or loss calculation. Then calculation of terminal cash flow. In that, sale value of land, an amount of 35 lakhs plus sale value of building complex, an amount of 5 lakhs minus capital gain tax. We have been provided with very good information in the question without any ambiguity that capital gain tax is also 25%. Even if that information would not have been given specifically, we would make an assumption that the capital gain tax rate and income tax rate is same. So 5 lakhs plus 5 lakhs, total it is 10 lakhs into 25%. So 2,50,000. So terminal cash flow, 40 minus 30, that is 2.5, that is 37,50,000. And this is the amount I'd say we are going to receive year to end. That is what we understand. After this, in step number 4, recurring cash flow, calculate answer for the first year. Only first year I want you to tell me answer in the chat box. What is the cash flow in Chinese Yuan term, that is in the nominal term. Step number 4. Recurring cash flow for first year and second year. Friends, over here we can see that's the sales value, cost, and the cash operating cost. All of them are subject to inflation. So I'm doing answer like this. Working note number 1. Calculation of profit before depreciation and taxation. In bracket I'm writing in real terms, because you can see that the information is provided to us like this. Selling price is 500, variable cost is 40%, number of units are 10,000, and this is 22 lakhs, and all of them are subject to the inflation. So we understand like this. Sales, how many units? 10,000. What is selling price? 500. That comes to an amount of 50 lakhs. Variable cost is 40%. That comes to 20 lakhs. Cash fixed cost is 22 lakhs. So we get profit before depreciation and taxation as 8 lakhs. This is what we get profit before depreciation and taxation in real term. Next, calculation of the cash flows. First year and second year, profit before depreciation and taxation. For year 1 it will be 8 lakhs into 1.08. For the second year it will be 8 lakhs into 1.08 raised to 2. Then depreciation, it is 15 lakhs divided by 2, 7,50,000 for the first year, again 7,50,000 for second year. From the income we'll deduct the depreciation to find PBT. Income tax rate is given 25%. PAT is 75%. Add back depreciation. So profit plus depreciation is cash flow. Year 1 and year 2 cash flow will be calculated, and with that we will make further calculation. 8 lakhs into 1.08, 8,64,000. Minus 7,50,000 is 1,14,000. Minus 25%, 85,500. Plus 7,50,000, 8,35,500. That is how a cash flow for the first year can be found. Second year it is square of 1.08 into 8 lakhs. 9,33,120 minus 750, 183,120 into 0.75, 137,340 plus 7,50,000, 8,87,340. This is the way the cash flows can be found. Step number 5. Calculation of NPV. In that, working note number 1, calculation of D0. It is face value of equity share into rate of dividend. What is the face value of equity share? It is 10 and this is 25%. So 2 rupee 50 paise. Working note number 2. Calculation of amount received. It is issue price minus flotation cost. We can see that over here the information is provided with the P0. Regarding issue price, no information is given. So in that case, we'll assume that the issue is at the current price, that is 200, and 1 GDR is equal to 5 equity shares. So 200 rupees per share into 5 minus flotation cost, which is given to us as 1% of the issue size. So minus 1%. So 200 into 5, 1000 minus 1%, 990. Okay. What is the growth rate? Growth rate is 10%. So K is D1 divided by P0 minus flotation cost plus growth rate. Dividend per share is 2 rupee 50 paise into 5 shares, fine, into 1.10. to convert that into T1 divided by 990 plus 0.10. 2 rupee 50 paise into 5 is 12 rupee 50 paise into 1.1, 13 rupees 75 paise upon 990, 0.0139 plus 0.10. So 0.1139, that is 11.39%. Next is calculation of NPV. So first year and second year cash flows. First year it is 8,35,500. Second year it is 8,87,340. Plus the amount of the terminal cash flow. It is 37,50,000. It will be discounted at foreign currency adjusted cost of capital 11.39%. Present value, and based on that NPV will be found, taking investment as 45 lakhs. So 11.39%, 0.8977. Second year it is 8059. 8,87,340 plus 37,50,000. So 46,37,340. 8,35,500 into 0.8977. So 7,50,028. 0.35. 46,37,340 into 0.8059. So 37,37,232.31. So present value of the cash inflow 44,87,260.66. Investment 45 lakhs, that is for the land and building. NPV of the project 12,739.34. NPV is negative, so we understand that the project should not be undertaken. Let us see now. So the question number A in that, identify the future expected cash flows and determine NPV. This is what we have done. Now further the question says that determine whether Opus Technologies should go ahead for the project or not, assuming that there are neither any restriction on transfer of the funds from China to India, nor charges or taxes payable on the transfer of the funds. So the question that we have done is, of course, with this assumption only. Okay. So we can say that of course the project should not be undertaken. Why? Because NPV is negative. Whether we do the answer of the NPV in domestic currency or in foreign currency, the decision is not going to change. So write down answer. Above calculation is made, comma, based on the assumption that there is no restriction on cash flow repatriation, comma, so project should not be accepted, comma, since NPV is negative. This is what we understand. So friends, if at all we do the answer in home currency approach, the answer is going to be obviously same. I just give explanation to you for that. See, for that, say we are required to take into account, say the interest rates. It is 12% in India and 10% in China. We have been provided with the exchange rate. It is 9.5. So we have to work out the answer in this way. First of all, working out number 1, calculation of exchange rate as per interest rate parity theorem. So spot exchange rate is provided as 9.50 rupees per Chinese Yuan. First year and second year, 9.50 into, as far as the rupee currency is concerned, for rupee currency the rate of interest is 12%, and for Chinese currency it is 10%. So it is 12 and 10% over there. 9.50 into 1.12 raised to 2 divided by 1.10 raised to 2 once again. So in that case it is 10.64. Sorry, divided by 9.6727. $9.8486. So this is the way the exchange rate will be calculated. Then calculation of NPV, calculation of the discounting rate. Rupee currency and Chinese Yuan currency. For rupee currency, the rate of interest is 12%. So 1 plus RF divided by 1 plus K. 1 plus RF divided by 1 plus K. This is 12 and over there it is 10. It is 11.39%. And over here it will be 1 plus K. Okay. So 1 plus K is equal to 1.12 into 1.1139 divided by 1.10. So it is 13.42%. Then NPV calculation. Year 0, year 1, year 2. Cash flows in rupees term. Amount of investment is 45 lakhs into 9.5. First year cash inflow is 8,35,500. So 8,35,500 into 9.6727. It is converted into rupees. Second year, the cash flow is 46,37,340. 46,37,340 into exchange rate is 9.8486. Now this will be discounted at 13.42%. First year factor is 0.8817. Second year it is 0.7774. 45 lakhs into 9.5. So that comes to 4 crore 27 lakhs 50,000. Year 0 discounting factor is 1. So 4 crore 27 lakhs 50,000. 835,500 into 9.6727. That comes to 80 lakh 81,540.85 into 0.8817. So that comes to 71 lakh 25,495. Second year it is 46 lakh 37,340 into 9.8486. That comes to 4 crore 56 lakhs 71,306 into 0.7774. That comes to 35 lakh 50,000, sorry, 3 crore 55 lakhs 4,874. So the NPV is 1,19,631. 7125,495 plus 355,04,874 minus 427, 50,000. Yes. Divided by 9.5. That comes to 12,592. So over here it is very near to this value. Maybe because of some approximation, the answer is say coming like this. Otherwise it will exactly tell you. So we understand that so this is the way you can cross verify the answer. That's very simple. Now second part of the question, calculate a revised NPV. If the company, that is Opus Technology, can transfer the funds at the end of the project, that is at the end of the second year, and internal cash accruals cannot be reinvested in China. That is the question. Okay. So let us understand how to make calculation of answer for the second question. Now the question says that, now second part of the question, in that we understand that say we are required to make the revised NPV calculation. Now over here we understand that so the question is providing the information that internal cash accruals cannot be reinvested, and in that case we will compute the NPV like this. Let me explain you. We will have the working note number 1, calculation of the forward exchange rate for rupees per Chinese Yuan. for the second year to be calculated. Then second, calculation of discounting rate for rupee currency. That is what say I have just calculated. Third, cash flows will be repatriated in India and then it will be discounted at this rate. This is the way we are required to find NPV calculation. Because when you have the normal NPV calculation, then in that case we have an assumption that so the internal cash accruals are reinvested at the discounting rate at which the NPV is calculated. But that is not the case over here. This is the reason we are required to make the calculation in a slightly different manner, and just we will be careful this time that say when we are supposed to convert the cash flow, then in that case we will say use the exchange rate. We don't have to convert it and then say we will repatriate. The year in which we are going to repatriate, in that year only we are going to convert. So right on answer. We'll make the calculation and that will give us clarity. Working note number 1, calculation of forward exchange rate as per interest rate parity theorem for the second year end. 9.50 into 1.12 square divided by 1.10 raised to 2. $9.8486. That is the forward exchange rate. Working note number 2, calculation of the cost of capital in a rupee currency term. This is for rupee currency and this is for the Chinese Yuan. So it is 10% divided by 1.1139. 12%, 1 plus RF. Sorry, that is 1 plus K. So now 1 plus K is equal to 1.12 into 1.1139 divided by 1.10. So 13.42. That is the discounting rate for rupee currency. Next, calculation of NPV in rupees term. Year 0 and directly second year. Year 0 cash outflow is an amount of 45 lakhs. This is in the Chinese Yuan currency. Exchange rate 9.50 rupees per Chinese Yuan. Second year it is 835,500 plus 4561 1306. Okay, this amount. Sorry, 46 lakhs 37,340. Because total of both of them will be repatriated. So it is 46 lakhs 37,340 plus 835,500. 54 lakh 72,840. Relevant exchange rate will be applied for conversion. It is 9.8486. Will they get the cash flows in rupees term? 45 lakhs into 9.5. So 4 crore 27 lakh 50,000. Then 54 lakh 72,840 into 9.8486. So 5 crore 38 lakhs 99,812. It is discounting at 13.42 and present value 1.1342, 0.8817, 7774, 4 crore 27 lakh 50,000 into 0.8817. So in that case it is 3 crore 76 lakhs 92,675. 538,99812 into 0.7774. Sorry. Year 0 cash flow will not be subject to discount. Sorry. 5 crore 38 lakhs 99,812 into 0.7774. So it comes to 4 crore 19 lakhs 1,713. So it comes to 8 lakh 48,287. That is the way the NPV is found, which is negative, so the project should not be accepted. Write an answer. As NPV is negative, comma, the project should not be accepted. Full stop.